I mean, I want you to just imagine the food on your plate right now. Like, really picture it.
Oh, yeah. Usually, when we think about where that food comes from, our minds go straight to, a peaceful farm.
Right. A tractor moving slowly across a field, maybe some gentle rain. It's a very comforting, very simple image.
Exactly. But the reality of how that food actually made it to your plate, it is anything but simple.
Yeah, you are basically looking at the end result of a multi-billion-dollar global technology and, frankly, a massive financial chess match.
To put that into perspective, the moment a seed goes into the ground, it is already interacting with a highly complex, globally interconnected system,
We're talking microscopic biological discoveries, right?
right? And algorithmic supply chain logistics. Plus, major geopolitical shifts that ultimately dictate what ends up in your grocery cart.
And more importantly, how much you end up paying for it. Okay, let's unpack this because today our mission is to look under the hood of one of the absolute titans of this global food system.
Yeah, it's a fascinating one.
We are taking a deep dive into the Q1 2026 earnings report and the news release from Corteva Agriscience, trading under the ticker CTVA.
And the numbers here are really a wake-up call.
Our goal for you today is to understand how macroeconomic tensions, cutting-edge biological tech, and, well, a historic corporate restructuring are literally reshaping global agriculture.
Because in the first quarter of 2026 alone, Corteva pulled in $4.9 billion in net sales.
Right. 4.9 billion just in the first quarter.
Just in Q1. That is an 11% increase from the previous year. And their operating earnings per share, it jumped 33% to $1.50.
Wow. I mean, for a physical commodities business, a 33% jump in operating earnings per share is massive.
It really is. And, operating EPS essentially strips out the noise of one-time financial events, right?
Yeah, it just looks at the profit generated by the core business of selling seeds and chemicals.
Exactly. What is crucial for you to understand is that these numbers are not just isolated corporate wins on a spreadsheet.
Right, they mean something much bigger.
They are a direct reflection of shifting global supply chains, intense market pressures, and a huge wave of technological adoption happening out in the fields.
Let's move from those raw billions to the why. Because to understand Corteva's financial surge, you really have to look at the global landscape.
Yeah, and the intense pressures facing their primary customer.
The farmer, right. I was reading through the underlying agricultural fundamentals in the report, and I started to think of the modern farmer less as a guy on a tractor and more like, well, like a Wall Street risk manager in
Right.
overalls.
Oh, that's a great way to put it. The modern agricultural economy demands exactly that mindset.
Because today's growers are managing complex risk portfolios.
They absolutely are. Every acre they plant represents a substantial upfront capital investment.
Uh,
We're talking fuel, fertilizer, seed, labor.
yeah. And they have to weigh all of those input costs against what they project the crop will actually sell for at harvest time.
Right, because they aren't just planting seeds and hoping for the best.
They are actively hedging against global geopolitical volatility, right? And supply chain constraints and weather patterns.
Exactly. And the sources point out that global agricultural fundamentals are a bit of a mixed bag right now.
Yeah, farmers are managing their input costs with a fine-toothed comb.
And yet, despite that careful cost management, the data shows they are actively prioritizing investments in yield-enhancing technologies.
So they are still buying the expensive stuff.
They are buying advanced genetics because they have to. If we connect this to the bigger picture, Corteva has reaffirmed its full-year 2026 guidance.
Okay, what does that look like?
They are projecting between $4.0 and $4.2 billion in operating EBITDA.
Let me stop you there for a second. For anyone listening who might not spend their days reading financial statements, operating EBITDA is basically a measure of a company's core profitability, right?
Yeah, precisely.
It is the cash generated from operations before accountants factor in things like interest, taxes, depreciation.
Spot on. It gives you a clear look at how much cash the actual business of selling agricultural products is generating. Got it. And that $4.0 to $4.2 billion guidance is essentially a major bet. It's a bet that farmers will continue to spend on premium agricultural technology to guarantee their crop yields.
Regardless of what is happening with global instability.
Right. And speaking of how global factors influence local farms, the macroeconomic pressures outlined here are really fascinating.
Oh, absolutely. The report notes that reduced export availability from China is actively contributing to a gradual tightening in global supply and demand dynamics as the season progresses.
which just demonstrates how interconnected the whole system is.
Yeah, because when a major player like China reduces its agricultural exports, the global supply shrinks.
Exactly. That keeps global crop prices from falling through the floor, which in turn gives farmers in places like North America or Europe the financial confidence to keep investing in high-end seeds and crop protection for their own fields.
Oh, I see. So the grain and oilseed markets are showing some improvement because of this slightly more constructive backdrop.
That's it.
The report even touches on military conflicts, which kind of blew my mind.
Yeah, it specifically notes that the ongoing conflict in Iran is currently seen as not materially impacting North American planting decisions.
Which is wild to think about. That a farmer in Iowa is operating in a market so global that conflict in the Middle East has to be factored into their seasonal outlook.
Even if, in this specific case, the sources indicate it isn't changing what they put in the ground.
It really illustrates the point about the farmer as a risk manager. I mean, why would an Iowa farmer care about the Middle East?
Because agriculture runs on diesel fuel
Mm.
and petroleum-based fertilizers.
Right. So any geopolitical event that could potentially disrupt global shipping lanes or oil supplies is a data point they have to consider when budgeting for this season.
Exactly. But as the report notes, they are currently weathering that specific variable without altering their planting strategies.
Okay, so if farmers are acting as risk managers, how does that translate into what they are actually buying from Corteva?
That's the big question.
Let's break down Corteva's two main business segments to see where the money is really flowing. We have seeds and we have crop protection.
And the seed segment was the undisputed star of the first quarter,
Yeah, the seed division was an absolute powerhouse. Net sales for seeds hit $3.02 billion.
which is up 12%.
Yeah.
And the profitability of that segment was even stronger.
Right. Operating EBITDA hit $1.034 billion, up 23%.
And they expanded their seed margin by about 310 basis points.
Just to clarify the jargon for you listening, a basis point is 1/100th of a percentage point,
Right. So 310 basis points means they improved their profit margin by 3.1%.
which in a multi-billion-dollar business is a huge amount of capital.
It is massive. The report notes that the volume growth was driven by seasonal timing shifts and favorable weather in North America and the EMEA region.
Meaning Europe, the Middle East, and Africa. But the really telling number to me is that price and mix were up 3% globally.
Yeah, what's fascinating here is that 3% figure. It proves that Corteva has formidable pricing power for its premium genetics.
We are talking about highly engineered products here, like their Enlist E3 soybeans and their Chrome corn.
Exactly. Farmers are willing to pay a premium up front because they trust the technology will deliver a return on investment.
The seeds might cost more, but if they guarantee a higher yield and resist pests better, that is a calculated risk the farmer is totally willing to take.
Right. But then we look at the other half of the business, the crop protection segment.
Yeah, let's talk about that. Net sales were $1.88 billion, up 10%.
And volume grew a healthy 6%.
And the report says this was driven by strong demand for new products and spinosins. Now, before we go further, what exactly is a spinosin?
Oh, it is a great example of where agricultural technology is heading. Spinosins are not traditional synthetic chemicals created in a lab.
Okay, so what are they?
They are naturally derived insecticides. They're actually produced through the fermentation of a specific rare soil bacterium.
Wait, really? A bacteria?
Yeah. The beauty of a spinosin is that it targets specific pests that destroy crops, but it generally leaves beneficial insects alone.
Oh, wow. And because it is naturally derived, I'm guessing it breaks down quickly in the environment.
Exactly, making it highly desirable for farmers looking for effective but sustainable pest control.
Okay, well, that makes perfect sense why demand is up 6%. But here is where I have to push back a little on the financials.
Okay, let's hear it.
If demand is so high across the board for these new products, and they have all this pricing power on the seed side, why did crop protection prices actually drop by 2%?
Yeah. The competitive market dynamics between seeds and chemicals are starkly different right now.
How so?
The report explicitly points to intense pricing pressures, particularly in Latin America, specifically Brazil and Argentina, as well as the Asia-Pacific region.
Because the crop protection market in those regions is crowded, right?
Very crowded. You have multiple generic manufacturers and global competitors all fighting for market share.
So it's essentially a price war in places like Brazil.
Basically, yeah.
If you are a farmer down there, you have a lot of options for what to spray on your field, so Corteva has to drop its prices just to stay competitive.
Effectively, yes. But here is the critical part, and it really speaks to their operational execution.
Okay.
Despite that 2% drop in price, the operating EBITDA for the crop protection segment still grew by 15%, reaching $434 million.
Wait, I need you to walk me through the mechanics of that. How do you drop your prices in a competitive market but still grow your profits by 15%?
It comes down to two main levers. First, Corteva offset those price declines through rigorous productivity savings and lower input costs.
Meaning they found ways to manufacture those chemicals more efficiently?
Exactly. And they sourced the raw materials cheaper than they did the year before.
Okay, that makes sense. And the second lever,
Second, they had a significant tailwind from favorable currency exchange rates, specifically the euro and the Brazilian real.
okay. So if they sell a product in Brazil for the same amount of local currency, but the Brazilian real has strengthened against the US dollar.
That sale translates to more dollars when they report their earnings back in the States.
Exactly. So even though they were taking a hit on the sticker price to stay competitive, their underlying manufacturing costs dropped enough, and the currency moved in their favor enough to drive double-digit profit growth.
Right. It's a very impressive balancing act.
Okay, so both halves of the business seeds and crop protection are growing. They are generating billions in revenue, and they are expanding their margins. So what does this all mean?
Well,
Because if things are going so well together, why is Corteva actively planning to rip the company in half?
that is the multi-billion-dollar question. And it's because the long-term vision requires a massive strategic pivot.
Right. They are on track to separate into two independent, publicly traded companies in the second half of 2026, targeting the fourth quarter.
It's a huge move.
It feels a bit like an amicable, highly calculated divorce where both parties want to make sure the kids, the shareholders, in this case, get a trust fund and a perfectly clean slate.
That's a pretty good analogy, honestly.
Let's look at who gets what in the split. The advanced seed and genetics company is going to be named Vylor.
Right. And the crop protection and biologicals business will keep the legacy name, becoming known as New Corteva.
And they've already announced Luke Kissam will be the CEO of New Corteva. They filed their initial Form 10 with the SEC, which is the regulatory document required to make this public.
Yeah. What's fascinating here is the strategy of creating what the market calls pure play companies.
Pure play, right.
By separating Vylor and New Corteva, each can focus solely on its specific market dynamics.
Which makes total sense based on what we just talked about. Vylor can dedicate all its resources and R&D to high-margin genetics where they have all that pricing power.
Exactly. While New Corteva can focus entirely on navigating those fiercely competitive global chemical markets, adjusting their supply chains and pricing models without dragging down the seed business.
Precisely. But the financial logistics of a split like this are just monumental.
Oh, absolutely. They are estimating the one-time separation cost to be around $350 million.
Just to do the paperwork and physically divide the global assets.
Right. And there's also the issue of what they call dyssynergies, right?
Yeah, because when you split a company, you suddenly have to pay for two human resources departments, two IT systems, two legal teams. You lose the synergy of sharing those costs.
Yes. They estimate the net dyssynergies to be around $100 million.
Wow.
Though the report noted that it's trending favorably, with only a $50 million impact included in their full year 2026 guidance, management is clearly working hard to streamline those duplicated costs.
And they're making absolutely sure both of these new entities hit the ground running with flawless financials.
Oh, yeah. In April 2026, the board approved a discretionary pension contribution of approximately $1.5 billion.
That is billion with a B.
That move is entirely about securing the future for both new companies.
I really want to break down why that matters, because throwing $1.5 billion at a pension fund right before you split sounds kind of counterintuitive if you're trying to save money.
It does sound weird on the surface.
But it is actually a brilliant financial mechanism.
If we connect this to the bigger picture, by making that pre-tax contribution to the principal U.S. pension plan now, they're wiping a massive legacy debt off the books.
Right. Because when credit rating agencies look at the newly formed Vylor and New Corteva, they won't see a giant lingering pension obligation hanging around their necks.
They will see completely clean balance sheets.
And the report explicitly states this is designed to ensure both companies have investment-grade credit ratings from day one.
Which is critical in agriculture. These companies need to constantly invest in new factories, supply chains, and R&D. Having an investment-grade credit rating means when they go to borrow money to fund that growth, they get much lower interest rates.
So that upfront 1.5 billion saves them untold millions in borrowing costs down the line.
It really is the ultimate clean slate. And just to sweeten the deal for the current owners, Corteva is returning capital to shareholders right now.
Remaining on track to complete a $500 million share repurchase in the first half of 2026.
It projects deep confidence to the market. They are essentially signaling that their cash flow is so strong they can afford to split the company, fully fund the pension, manage global supply shocks, and still buy back $500 million of their own stock.
All right, so Vylor is taking the high-tech seeds. That leaves New Corteva. What exactly is New Corteva's blueprint for survival and growth?
That's the exciting part.
Because we just established that the global crop protection market is basically a knife fight over pricing.
Right. And the answer isn't just relying on traditional synthetic chemicals. In fact, their strategy is looking backward to nature in order to move forward.
Here's where it gets really interesting. New Corteva is aggressively establishing what they call a natural product leadership position.
Yes, they are.
They are building a proprietary microbial library that contains over 750,000 different strains.
It's massive.
And they are heavily investing externally, like their joint venture with Hexagon Bio, and making 7 other investments through a vehicle called Corteva Catalyst. They are building an entire nature-inspired pipeline.
Now, this raises an important question, especially in today's corporate climate. Is this just a PR move to appear environmentally friendly?
Right, like greenwashing.
Exactly.
Yeah.
But looking at the sources, this is a calculated pivot driven by pure efficacy and scale.
I want to focus on that scale for a second. Having a library of 750,000 microbial strains sounds like a tech company mining data, but they are mining biology.
That's a perfect way to look at it.
How do they actually turn a microbe into a product that a farmer can spray on 1,000 acres of corn?
That is where their trade secret fermentation capabilities come in. You can think of it a bit like a highly advanced industrial version of brewing beer.
Okay, I can picture that.
But instead of using yeast to ferment grains into alcohol, New Corteva uses massive bioreactors to cultivate specific, highly specialized microbes.
Wow.
They control the temperature, the nutrients, and the environment perfectly. So these biological organisms multiply to a massive scale while remaining stable enough to be packaged, shipped, and ultimately sprayed onto a hot field without dying.
And the pipeline they are building from this process includes biological products like Utrisha N, alongside differentiated chemistries like Jimvelva and Inatrek.
Yeah.
Give us a concrete example of what one of these biologicals actually does in the dirt. Take Utrisha N, for instance.
Oh, Utrisha N is a perfect example of why this technology is so valuable. It is a biological product based on a specific bacteria. When a farmer applies it to a field, the bacteria actually colonize the plant's leaves. Once there, they pull nitrogen directly out of the air and convert it into a form the plant can use to grow.
That is incredible. They're basically turning the plant itself into a nitrogen factory.
Exactly. Which means the farmer doesn't have to buy and apply as much synthetic nitrogen fertilizer.
That saves the farmer money, it reduces chemical runoff into rivers, and it secures a reliable nutrient source for the crop.
And that is why the financial projection backs up the science. They estimate this nature-inspired pipeline has a potential peak revenue of over $1 billion.
Yeah, you don't project $1 billion in revenue just to look green for a brochure.
No, you don't.
You do it because the product works, the manufacturing process scales, and the farmers are actively opening their wallets to buy it.
It represents a fundamental shift in how we approach crop protection and enhancement, moving away from purely synthetic chemistry and toward harnessing the mechanisms nature has already perfected over millions of years.
Okay, we have covered a vast amount of ground today. We started with Corteva's $4.9 billion first quarter success, which, as we saw, is really a story of global macroeconomics, careful risk management by farmers, and the immense pricing power of high-tech seeds.
We also unpack the impending historic corporate split that will create Vylor in New Corteva.
And a strategic financial mechanics like that $1.5 billion pension contribution designed to ensure both pure-play companies launch with stellar credit ratings.
And finally, we looked at New Corteva's future, a future driven not just by traditional chemicals, but by industrial fermentation, microscopic biologicals, and a library of 750,000 microbes.
So why does all of this matter to you? The next time you are standing in the produce aisle at the grocery store, looking at the price of corn or soybeans or even a cotton shirt, you should realize that the price and the very availability of those products are tied directly to these invisible machinations.
That's all connected.
It all connects from a currency fluctuation in Brazil to a geopolitical conflict thousands of miles away, to a microbe fixing nitrogen on a leaf, to a multi-billion-dollar corporate spinoff in Wall Street boardrooms.
The food system is just a marvel of modern engineering, biology, and finance, all working in tandem to keep shelves stocked.
And it leaves you with a really fascinating question to mull over. As agriculture increasingly turns away from traditional synthetic chemicals and begins to rely more and more on patented microbial strains and highly advanced proprietary genetics, who ultimately holds the real power over the global food supply?
Hmm.
Is it the farmer out in the field who actually plants the seed and tends the soil? Or is it the multi-billion-dollar tech company that engineered its DNA and fermented its defenses in a lab? Something to think about next time you sit down to eat.